Hi, everybody. It's Stacey and Meredith from the SALTovation Team, and we are here today joined with Davinia Lyon from our federal and state compliance team, as well as provision team. And we've asked Davinia to come be with us today to chat more through about tax provisions and who needs one, when they are triggered, and then we can also kind of chime in on some of the state stuff. So with that, I'm going to just start by asking Davinia, who's got lots of experience in this area. So let's start off with who needs a provision and when do they know they need one?
Okay, yeah. First, the main thing is obviously if you are a public company, if you're registered with the SEC, and typically if you're on any exchange, whether it's UK exchange, Canada exchange, any type of exchange with a public market, they are going to have a requirement where you file a tax provision. That's going to be obviously there's no option there. You have to do it. And then from there, it trickles down to a lot of times when I talk to clients, I'll ask them, what's the future plan for this company? If the plan is to go public, do an IPO or do a SPAC, which is all the rage lately, then I'm like, probably a good 18 to 12 months before, or 18 to 24 months before you do that, you should start building your tax provision. Because when you do those type of things, you have to report quarterly and you have to show comparables for the past years and quarters. So it's easier to do it concurrently rather than try to do it retrospectively and look back. And then the other thing would be is if the company's thinking about being sold, we're like, hey, we're going to build it up for 3-4 years and then we're going to sell it. Then it's like, okay, a good 12 months before you're going to think, maybe put it on the market, you want to probably do a provision. And the main reason around that is it's going to make your due diligence go a lot better because the company buying you is going to be asking you about your deferred tax assets and your tax payables, receivables. But also you can make the company more valuable by showing the fact that you have, future deferred tax assets, right? That's just more value to the company. And then last but not least, the other reason that a lot of companies will do a provision is it'll be a banking requirement, like their lender will require them to issue some type of financial statements, and then often there's a tax requirement within there. So that's typically what I see.
Okay, cool. And then I guess from a mechanic standpoint, if somebody's listening to this and doesn't really know what goes into it, what to expect, can you maybe shed some light for some of those people who don't really even know what this means?
Yeah. Yeah. So ASC 740, it's complicated. It has a ton of nuances to it, but the elevator speech version of it is it's basically looking at your what your tax basis is in the company. So it's done from a balance sheet perspective. So you have your, what's your tax basis in all the different attributes of the company versus what your book basis is. And that's going to give you either deferred tax asset, which is a future benefit, or deferred tax liability, which is a future detriment. And then the other component of it is looking at the balance sheet, looking at your current taxes payable, receivable balance, proving that out. And again, you take the change in balance period over period, and what falls out is your expense in theory or benefit. So.
Okay. And then, Mayor, from a state perspective, what do you think clients need to know with respect to more so on the mechanic side of it?
I think, a lot of times, like from a state perspective, it's, there will be, there'll be like a full valuation allowance. Companies will be operating in a loss, but we do have those, pesky states like Texas that while a margins tax, right, is, not truly an income tax, but for ASC 740 purposes, it is considered an income tax. And so, you could have, that could be kind of your only item that's rolling through from like a current tax expense. And so you could still have, again, like a current tax expense related to, that kind of state piece there. So there could be some value there, even though when companies are like, oh, I'm in a loss, I'm a full valuation allowance, I just need some like footnote disclosure. There are still some cash tax payments that are required. Some companies, depending, do take into account some of those minimum taxes that roll through on a current expense, while arguably may or may not be an income tax. But then to remember also, though, that franchise taxes, so those based on equity, are not part of your ASC 740 current tax provision. And so there are just like, as always, differences between what's going to be reported for Fed purposes and what's reported for state purposes.
Right. And that would be similar for like the Washington B&O too, right? So like the B&O typically is not considered, a net income based tax, which it's a gross receipts tax. So kind of back to your point on Texas, even though that Texas tax
Correct.
technically is gross receipts, it does operate like a net income based tax. So that's why it gets counted. Okay.
Yep.
Okay. And then what about from like, what do clients need to know with respect to, if states put in changes, maybe legislative changes or things like that through the course of the year? What are some takeaways for clients in order to handle those?
Yeah, so there is, and again, this is why it's, from a huge perspective, right? About like how big our clients are, like, again, what their evaluation allowance is and whatnot, is that you, generally when like for, I remember when I was a staff at KPMG and it was like, hey, why doesn't anyone care about your tax returns? It's like, well, because you can screw up a tax return sort of and fix it. Not ideal, right? But you can amend it. What you never want to do is screw up your provision, right? Because then you've got to potentially reissue your financial statements, which is a huge no-no. So it's like, there's a lot of credence given to the provisions. And so, from a state perspective, oftentimes, if filings have changed, incorporating those filings, because, the apportionment factor times the state rate is going to change your blended, state tax rate. So kind of understanding your footprint from like where you're filing perspective, known legislative changes, right? So, I think what North Carolina is talking about getting rid of their income tax altogether. So if that goes away, that changes your blended deferred rate. And then just changes in business activity, right? So if you buy a company and your California apportionment factor is going to go from, 10% to 80%, that is also going to have, an impact on your deferred rate for state tax purposes. So really understanding what you're doing, when, where, how, and why, and potentially updating that year over year if your prior year, because oftentimes it isn't material where you have pretty consistent business activity year over year. You can take your prior apportionment, prior filings, and roll it into the newest provision because there are no material impacts. But in some cases there are, an understanding whether or not your year over year activity is reflective, where you can use kind of prior year apportionment and whatnot, but always changing for known like current year's tax rate. Because often the deferred state rate is going to be your apportionment factor per that state times your state rate, added with like a net benefit. Super high level. Davinia's like, yeah, it's a little more complicated. But yeah.
Okay. And then I guess from your point of view, Davinia, what have you seen, or maybe what are some best practices or some things maybe you've seen that clients have struggled with?
I think Meredith kind of hit the nail on the head, so to speak, with you really need to know what your business is doing, what your company is doing, because if they just had a huge sale in some state where they're going to be sending a ton of people and they didn't have that before, I mean, you need to be able to build that in and factor that into your deferred rate down the road. And that's something that auditors will notice and ask, if you have a big, to Meredith's point, the tax return oftentimes does get overlooked from a materiality perspective and that kind of thing. But at the same time, you have your return to provision accruals that are going to run through the next year. And if you miss something on a return, your provision's not going to be right. But conversely, it's like if you're not planning of what that return, what your tax is going to be, your auditors are going to be like, well, do you have a material weakness or a SOX issue because you didn't know what was going on in the business and you didn't factor that in appropriately. So I think that's definitely one of the key areas. And then of course, tax being the United States, it's 50 different states with all different ways they approach it, and just being up to date all the from a tax law perspective of what's going to take effect when.
Okay.
And then I guess just really quick, Davinia, how do you are there any kind of tips that you can say, just, because we are a tax only firm, right? And so we deal with, we prepare provisions and then we're dealing directly with, our clients' auditors, just kind of like how to create like a really good working relationships with, our clients' auditors, so that we can work in partnership.
Yeah. I'm really big in taking a collaborative approach. When I first started doing tax provisions, this was many, many years ago. And it was really interesting. There was almost like this completely combative relationship between the tax department and the auditors, right? It was, at the time, the director of tax that I worked for, he was like, well, we don't tell them anything until they ask. And I used to like literally lose sleep at night because I was like, if they find this, it's going to look really bad. And what always inevitably happens is they're going to find it at 11 o'clock p.m. the night before we're supposed to file, right? And then you have this huge blow up and this huge issue. And over the years, that has changed, I think, in general mentality. But for me specifically, I would much rather be collaborative with my auditors. So actually, I just have a client that I had a call with them this morning, and they were asking me, I was like, I think this is the position I'm going to take on the audit or on the provision. I mean, I'm going to email the tax partner at the other firm who's doing the audit and just be like, hey, do you agree with me? Because they can't, as your auditors, they can't tell you how to do your provision, right? There has to be that independence, but you can definitely talk to them and say, this is the position we're taking. Do you think there's an issue? There are times where maybe it's a really controversial position, and therefore I will go to another firm first, have them give me like more of a technical opinion, and then I'll take that to the auditors. But that's usually, pretty rare, because it has to be something highly technical or controversial. So yeah, so be as upfront and open with your auditors, I think, as you go through the process, so there's no surprises by anybody. Like I
Right,
said,
because no one wants to be making changes at like 2 a.m. the day of issue.
yeah, the CFO controller is going to be pissed if that's what happens. So it's like you don't want that to be on you. So, yeah.
I think that's really good advice and a
Yeah.
really good perspective.
Okay. Anything else anybody wants to chat about or leave the audience with?
Davinia is great at provisions and she loves them, and they are a giant
I do
puzzle to
love them.
her, just like figuring out your sales tax compliances for us, right? Your state tax footprint. We're all little weird tax people that have their niches, and Davinia's great at this and she's really good at it.
Yeah.
So call Davinia.
That's right.
Thanks.
Yeah. So I can't say it any better, Mayor. So but thanks, Davinia, for your time. And
Thanks.
as Mayor said, everybody can reach out to you for your expertise and advice on provisions. And thanks for joining
Happy
us.
to help them through. Yep.
All
Thank
right.
you.
Cool. All right. Well, thanks everybody for joining today on our SALTovation ASC 740 discussion, and give us a call if you need us. Bye.
Thanks.